Welcome, everyone. We're going to be getting started in a few moments. Thanks so much for joining us tonight. Welcome, everyone that's just joining us. We're going to give it a few more minutes before we get started. Feel free to introduce yourselves in the chat box if you'd like. Not necessary. I'm Melissa Clark from United Way. It's great to see you all tonight. Welcome, everyone. Great to see you all. Thanks so much. Hi, Jonathan and Alexis. Thanks so much. Great to see you all. We're going to get started in a few minutes. Thanks again to Ulster Savings Bank. It's going to be a phenomenal presentation. We're so excited. We're so thrilled. Welcome, everyone. We're going to give it a few more moments. Feel free to introduce yourself if you'd like. If you feel like telling us how you heard about this presentation, it'd be great to find out. So great to see so many of you here on a Wednesday evening. Hi, Jeannie. Hi, Michael.
Hi, everyone.
It's great to have another one in the series. It's been a little while, so it's excellent to have another financial literacy presentation and have our new cohort of Vistas. Hi, Kat. It's great. She heard about it from Hudson River Housing. Stephanie heard an ad on the radio. It's great. Thanks so much, everyone, for being here. We have a lot of folks that are just joining us in the waiting room, so just bear with us for a few more moments. Ashley heard about it on Facebook. Oh, from a realtor. Very cool.
That's
yeah,
great.
So yeah, definitely. That's wonderful.
Yeah,
Oh,
so far.
From
Everybody from a different source of hearing about it. That's wonderful. Yeah.
Absolutely. Word has really gotten out. From a mortgage representative of Ulster Savings. Now that makes sense. Great. So we've got 40 people so far, and people are just, they're just keep entering our waiting room. So if you're just entering, just bear with us for a few more moments as we admit everybody and just seeing how everyone's doing tonight. If you want to share how you heard about this presentation and introduce yourself in the chat box, love to see who's on tonight. Chloe heard about it through Christy at Ulster Savings and Paul through a mortgage specialist at Ulster Savings. So great job, Ulster, getting the word out.
Yeah, they're all coming in now. This is great.
Absolutely. Through Ulster Savings, Facebook, Ulster Savings. Yes, this is fantastic. We already have over 50 folks on, so wonderful. Thanks so much, everyone. We're just going to get started in about 2 more minutes. So if you want to just introduce yourself in the chat box, that would be great. Let us know how you heard about the event. Email from everyone from Ulster Savings. This is wonderful. So many different ways everyone has heard about this workshop. We're going to learn so much tonight. And we still have folks that are in the waiting room. We're already over 60, so we're just going to give it a couple more minutes and then I'll be turning it over to Michael to officially kick us off.
Yeah, it's just 5:31, so we're doing well.
Thanks, Jeannie. And yes, heard it on the radio, heard it from Ulster Savings. It's wonderful. So if you want to say your name and where you heard about the workshop, we'd love to hear about it. So feel free to put that in the chat box if you'd like. It's so great to see everyone here on a Wednesday evening. Thank you so much for being here. Thanks for your time. Thanks to Ulster for this partnership and sponsorship and everything they do. Like Facebook, from
That's
a
great.
meeting, from Lavos, from Ulster. This is fantastic. Thanks so much. We have about 65 folks so far. This is wonderful. It's so great to see you all here on a Wednesday night. Thank you so much for being here. We can give about 1 or 2 more moments and then we'll kick it off and I'll turn it over to Michael. So we're just letting everyone in the waiting room right now. So thank you so much for being here. Thanks to Ulster. From Lavos, excellent. So if you are just joining us now and you want to say your name and where you heard about the workshop, feel free to put that into the chat box. Love to hear how the word is getting spread out in the Hudson Valley. And welcome everyone. We're going to get started in 1 moment. So if you're just joining us, thank you so much for being here. We really appreciate it. We're going to learn so much tonight, we promise. Thank you so much. If you feel like writing your name and how you heard about the presentation, feel free to put that into the chat box.
Oh, recap.
Excellent. This is great. There's 70 of us here on a Wednesday evening. All right, fantastic. Well, I'll keep letting folks in as they join, and we're still having folks entering the waiting room, but I don't want to take up any more of your time. We really appreciate your time. So I'm going to turn it over to Michael to kick us off and get us started.
Great. Wonderful. Thank you so much, Melissa. Good evening, everyone. I'm Michael Robertson of Financial Empowerment Vista at the United Way of the Dutchess Orange region. And we, all of us at the United Way, want to welcome all of you to tonight's Homebuyer Workshop presented by Ulster Savings. Thank you all so much for showing interest and taking time to be here. And I'm sure we'll all learn a lot this evening. We expect this presentation by David to last about an hour and a half, and we strongly encourage all of you to stay through all the way to the end. Before we get started, I'd like to make a couple quick announcements from United Way, just to let you know what's going on with our organization and how you can get involved. First, I'd like to say we'd encourage you all to participate in our strategic planning survey. This will help us identify our upcoming priorities, and you can participate in our community survey. It only takes a couple minutes, and we're going to put that survey into the chat box. So if you get an opportunity to take that survey, that'll be very helpful. I want you all to know about our voucher for free Lyft rides in the area. These are for COVID-19 vaccines. So if you need a free ride to get a vaccine, check the chat box and you will find the link there. Also like to bring attention to the 211 line. And we will have a link to that. That is, if you have any questions or concerns, that can be answered in your community. That's a great resource for you to go to. And one last thing is to bring attention to the United Way's community conversations. And we need your feedback. You can register for our community conversations. The next one's around youth pandemic barriers, mental health, and learning loss. And that'll be on October 21st. There's also an opportunity to volunteer with United Way. And we would love to have you volunteer at some of our events. And you can find our volunteer portal in the chat box as well. So a couple housekeeping things. If you can stay on mute the entire time, there are a lot of us that are in here and a lot of great interest in this, and that'll be helpful. If you have any questions for Ulster Savings, please ask them in the chat box. We'll have the opportunity for people to ask questions throughout the workshop. And again, we encourage you to stay on the entire time. Before we do begin, I would like to welcome Jeanne Montano. This is our president and CEO of our United Way, and she's here to say a few words. Jeanne?
Thank you, Michael. And I want to thank every one of you for attending tonight's first time Homebuyers Workshop. I have to tell you, I wish I had attended this before I bought my first and only home. So informative. But I want to thank the efforts of the staff at United Way. I get to work with an amazing group of people. So Michael, who you've met, Melissa is over there, Wade, Emily Darrow, she's over there. She keeps all this running, I gotta tell you. Natir, where's Natir? There she is. And Katie? Yeah, so thank you. I'm very fortunate to work with them. And you know, I just want to thank the Ulster team, David, Chris, Jose, and Christy, for making this possible. And just so you know, this isn't a standalone event. It's a series of financial literacy workshops, and we're going to be doing another one later in the fall. So definitely look out for that. And, you know, these workshops are an important part of our ongoing efforts to bring financial literacy and empowerment to our Dutchess and Orange County communities. In the 4 years of presenting these, I have to tell you, tonight we had a record number of people showing up. I think we're up to 78, which is amazing. But I also think it shows how significant an issue of housing and personal finance has become over the last 18 months. So, you know, this workshop couldn't come at a better time, that's for sure. So I just got to give another shout out to Ulster Savings Bank for making this possible. And I hope you all learn a lot tonight. And I'm going to turn it back to Michael. Thank you.
Thank you so much, Jeanne. Greatly appreciated to hear those wonderful words. And thank you all so far for joining us through this preamble. I hope you're settled in now and everybody's ready to go, because I'm ready to introduce David Friedman at Ulster Savings, who's going to be leading tonight's workshop. A little bit about David. It's always, I think, great to personalize these things a little bit. He's the business manager and mortgage trainer at Ulster Savings. He's been in the mortgage industry for over 25 years in a variety of positions, and he's worked for some of the biggest banks and mortgage companies in the country. And now he's been with Ulster Savings for 4 years, and he works out of the Kingston headquarters, and he's done these home buyer workshops for hundreds of clients and quite a few more tonight. He's also a lifelong Hudson Valley resident, married for 24 glorious years. That's fantastic, with 2 sons in college, and is currently fostering a service dog for the Blue Path Agency. That's fantastic, David. So without further ado, here's Dave.
Thank you, Michael. Sorry about that. Thank you, Michael. And thank you, Michael and Jeanine and Melissa and all of our friends at United Way, Dutchess and Orange. We really appreciate your support and letting us help you guys out with getting in front of people and helping to people to get into their homes. We still believe the American dream includes home ownership, and it's an important part of moving on in life. And we're happy to help in any way that we can with information and ultimately, hopefully, with getting you into your home. So without further ado, we'll get started. So just yeah, a little bit more about myself. Michael said, so I have been doing this. I have to update that. It's a little over 25 years now, maybe 26, 7. And I have done a variety of positions within the mortgage business. And I've been doing this for a long time. Basically, what I say, if you have any questions about it, I'll never say I've seen every scenario, but I've seen pretty close to everything, or everything that can be pretty close to what your scenario is. So there's not a lot that you can throw me off with when it comes to the questions. So let's go ahead and get started. I do want to mention a little bit just about Ulster Savings in general. So we are a community bank. We have been in business for over 170 years now, serving our local communities. We have 15 branch locations and 2 lending offices. We very recently just opened up our very successful launch of our Hyde Park location in Northern Dutchess. So we're very excited about that. Our mortgage operation centers are right in Kingston, and we have a very large office here where most of our operations take place. Of course, in the last year and a half, we do have many people that are working remotely, but this is still considered our home base. We do have branches and mortgage offices in Ulster, Dutchess, Orange, and Westchester County. So pretty much everywhere that we service, you're going to have somebody that's relatively local to where you are. And we're a full service community bank. We're the oldest in the region, still going strong. And basically that means, as a community bank, it means that we have no shareholders. Basically everything we do is in the best interest in serving our community and our members. And we're here, like I said, we're here to provide the services for you. You see at the top, in addition to just banking and mortgages, we also do investments, tax and payroll services, and we have our own insurance arm. So I definitely encourage you to check us out for basically any of your financial needs. We're the ones that you can go to, all one-stop shopping, and we're happy to help. So we will start up. First thing I want to go over, Michael mentioned as far as using the chat box for questions. We do have a couple people that are monitoring the chat box for us. What we'll do is we'll stop 4 or 5 times along the way to answer questions. I just ask that your questions relate to the topic that we're going over at that time. If it's something we haven't talked about yet, I ask you to be patient, because we're probably going to go over it as we go along. And if not, then again, go ahead and ask the question. After we're done, we'll stay on the line for a little bit longer and just open it up to fresh questions if anybody else wants to get on. Don't be shy about asking questions. I've done a lot of these things, and they definitely work better when there's some interaction with the clientele. Obviously, we can't do it if we were live. It would be a little different, where we could call on people. Here, we use the chat box. Just make sure you're responding to everyone, because I have a couple different people that are monitoring the chat box. So feel free to ask your question. And like I said, we'll stop a couple times along the way and make sure that everybody is still with us and understanding what we're talking about, because getting a mortgage can be a complicated process. We're going to do everything we can to simplify it, but I would never say it's a simple process. It's involved. One of your big 3 items in your life generally is looked at as getting married, having kids, buying a house. So this is something that you want to have some confidence going into the process, and you want to be as comfortable as possible. So very, very important. Don't be shy. Okay. So when we talk about lending, we talk about the 4 C's: capital, capacity, credit history, and collateral. Just a brief overview: your capital, that is the funds that you use to buy the house. So that would be, in addition to your loan, whatever down payment, closing costs, any type of second mortgage, grants, gifts, those types of things. All that is your capital for getting into the home. Your capacity is your ability to repay the loan. So that's how are we going to ensure, how are we going to convince the bank or the mortgage company that you're in a position to be able to make those payments going forward. Your credit history, very, very important. We're going to get into some great details there. And then collateral, that's the actual home that you're buying, regardless of what type of home it is. That's considered the collateral for the loan. Okay. So our first C, capital. What are we talking about here? Down payment, closing costs, escrow, and reserves. So we get a lot of questions about this stuff in terms of what is the required down payment? How much are the closing costs? And what does escrow mean? And do I need to have any reserves? So we'll go through a little bit about that. So down payment, there are many different programs out there that some require a down payment, some require a larger down payment than others. And we do have some programs that really don't require a down payment at all. Now, this doesn't mean that you can get into the home with no money of your own. It does mean that you may not have to put a down payment down as far as the lending goes. We can do essentially 100% financing. However, the seller of the property doesn't have to accept that. In other words, they may not want to take the house off the market if you're saying, well, I'm getting 100% financing. Well, they still may want you to have to put some money down to them to take the home off the market. And how much is that going to be? Don't know. That'll depend on the seller. So that's between you and the seller to work out. But let's say that they say you have to put down a percentage, 1% or 3% or something like that. Sometimes it'll be a dollar amount. They want $5,000 or $3,000 or something along those lines. That's fine. We can still do the 100% if we fit into that program. We can still do the 100% financing. And then the money that you gave to the seller would essentially go towards your closing costs and escrow and whatnot. So the money never just poof disappears. It's just going to be applied elsewhere. So, but ultimately, so even if you see advertisements for no down payment or 100% financing, just understand that is up to the seller to whether they want to accept that type of program or not. There's no law that says that they have to. But when you work with a reputable company that's going to issue you pre-qualification based on your characteristics, when you work with a reputable company like Ulster Savings, that pre-qualification certificate means a lot more, and your seller and your seller's realtor will have more confidence that you're actually in a position to be able to move forward with the loan. So that's your down payment. Like I said, that may vary depending on what you qualify for and what you're looking for. Closing costs. Everybody wants to know how much are my closing costs going to be? Well, I shy away from giving any type of dollar amount or percentage. And in fact, it kind of gets at me when I read things saying, oh, for closing costs, you can expect it to be 3% of the sales price or whatever. We really don't know until we get in. Every situation is a little bit different. Your closing costs, there's a lot of factors that go into the closing costs. Now, some of them are fixed costs. And when we're talking about, there's bank costs, things like the credit report or getting the appraisal done or title insurance and things like that. There's all things, some are bank charges, some are third-party charges, some are fixed, like your appraisal and your credit report. Those are going to cost you the same regardless of how much of the houses you're buying, whether it's a $100,000 house or $300,000 house. Your credit report fee is going to be the same. There's other costs that are dependent on the size of the house that you're getting. So if you're like your mortgage tax, that's one of the biggest fees that you're going to have. New York State has a mortgage tax. There's only about 6 states in the country that have one. Yay, us here in New York, we have one, of course. If there's a tax, New York will find it. So when we add that in, that'll depend on where you buy. In Ulster County, it's a little cheaper than it is in Orange and Dutchess County, and those are a little bit cheaper than Westchester County. So that can change from area to area. So I don't like to give out just a random number or percentage to people. What I do say is just work with your loan originator, work with your mortgage specialist, and they're going to work up a specific set of closing costs for you and your scenario. Okay. Escrow. The term escrow is used in a couple different ways. When we see it used in like TV or movies, a lot of times they'll say that they're going into escrow. That means something different than what we're using it here. That basically means that they're ready to close on their home. We don't use that. That's more of like a West Coast thing. We don't use that in the general mortgage business and in this area. That means we're setting up for your property taxes and your homeowners insurance. That's what's considered your escrow account. May also include mortgage insurance, flood insurance, things like that. But how much do we need to put in for there? That depends on how much the taxes and the insurance are going to be. It depends on what time of year it is and when the taxes are due. If we're closing right now when taxes are about to be due, that number might be a little bit higher. If we're closing at other time in the year, that number might be a little bit lower, but that's something that has to be taken into account. And then there's reserves. Basically, reserves just means whatever you have left after everything, all the paperwork is signed and the keys are slid across the desk to you, how much do you have left in your account after your closing? Some programs require reserves, some programs don't. The programs that do require it, again, it can vary. Some could be 2 months, could be 6 months worth of payments. It all depends. Everybody's situation can be a little different. And again, those are things that I ask you to just wait and work with your loan originator, your mortgage specialist, and make sure you're getting something that's a custom quote for you, because whatever it was for your neighbor or your uncle or whoever could be wildly different for you, depending on what situation you're in, okay, and what programs you qualify for. Okay, so where does all this money come from? So obviously, you have your loan, all right, so and then besides that, you'll see on the screen there, so personal funds, those are things like your checking account, savings account, money market, stock market, things like that. Could be retirement fund if you have any type of 401k or pension. If you can borrow against it, that's perfectly fine. Some programs may allow you to withdraw depending on your age and whatnot. You may be able to withdraw without penalty. Sometimes you may have to withdraw with the penalty. That's up to you if you want to use it. What I suggest is that you go over with your mortgage specialist, not what you intend to use, but what you have, because that will help them to direct you to the right program. Because again, there's sometimes you say, well, I have this amount in my account, but I only want to use a smaller portion of it because I want to have something left over, which is a great plan. But if you only give us the smaller number and it turns out you need just a little bit more, that could cause issues with qualifying. Whereas if we know how much you have, at least that gives us more flexibility, and we can then present it to you and you have the option of what way you want to go. Okay, so you'll hear me say this probably repeatedly. Just be open and honest with your mortgage professional. Make sure that they know everything there is to know about your financial situation, because the better information they have, the better they can work for you. And at the end of the day, they're working for you to get you into your home. So you need to develop that relationship with them. There has to be an inherent set of trust there, and you want to be open and honest with them about everything. Old saying, garbage in, garbage out. If we have the wrong information coming in, then what we're giving you at the end in terms of your qualifications may not be accurate. Okay, so we want to make sure we have that. Gifts. Most programs allow gifts if you have it available to you. Who can a gift come from? Again, depending on the program, that can be different people. Generally, every program would allow it to be a blood relative, fiance, partner, that type of thing. Like we would call that kind of first level. That generally is accepted. How much could you get? How much do you need? Again, depends on your situation. How much can you get? That's up to you. As far as how much should you get, plenty of people don't need and don't get anything, and plenty of other people get others. Again, everybody's in their own situation there. So family members, close family members, fiance, partner, that type of thing, that's kind of first level. And then there's other places that you might be able to get gifts from, family, friends, or employment. Sometimes there's employers will have a gift program set up. Those would be dependent on the program. Some programs allow it, some don't. So if it's something that you plan on getting or you think it might be available to you, again, let your loan officer know up front so that they can direct you in the right way, and we can make sure we're getting the documentation up front that we need, and also that we're putting you in the right programs that accept the type that you're getting. Okay. Seller concession. Seller concession, a little bit more involved. Basically, without getting into too deep of a dive on that, basically it's where the seller agrees to pay some of your closing costs. And you hear that correctly. The seller can pay for some of your closing costs, not for your down payment, but they can pay for some of your closing costs. Hey, that sounds great. Why doesn't everybody do it? Well, because the seller has to agree to do it, because that's essentially money out of their pocket. That's money that's coming out of the proceeds of the home that they're selling to you, that they're essentially giving back to you for closing costs. Perfectly legal. It's done all the time. But we want to, again, we want to know if that's something that, if you're coming in to see us after you've already discussed something with the seller or the seller side, you've already put in an offer, we need to know whether that's part of the plan or not. Okay, but it's fine. We use them all the time. So nonprofit grants and DPAL, you see the term DPAL, that stands for Down Payment Assistance Loan, Down Payment Assistance Loan. So basically, it's a loan for your down payment. There's a couple different programs that we use that have that as a part of it. And that's where I said before, when we have 100% financing, most programs don't allow that as a single loan. We do have a few, they're very specialized. But most of your program, or there's quite a few programs where we can do, say, a 97% financing on your mortgage, and then you can get a 3% DPAL, down payment assistance loan, for the remainder, which adds up to basically 100% financing. So there are different requirements that come along with those. Sometimes there's income limitations. You'll hear me say that a couple times. Some of these programs are specifically intended for what we call low to moderate income borrowers. So there's a certain threshold of income that you can have, and that changes by county generally, sometimes even by smaller areas than county. So that can come into play if you have a good idea where you're thinking about buying, and you're looking in Ulster. That's going to be a different number than Dutchess, which is again going to be a different number than, say, Westchester. And generally speaking, the closer you get to the city, the more leeway we have on that. The further north that we go, the lower those income limitations get. So that's something, again, if that's something that you're interested in. So we as a bank don't offer the grants or the DPAL. What we do is we assist you in getting them, and we use multiple different partners, not-for-profit agencies in our areas that I assume most of you are from. We have several different ones here. Hudson River Housing is typically Dutchess County. We have RUPCO, which is mostly Ulster County and some of Orange County. And we have Pathstone, which again primarily covers Ulster County. And then there's other agencies that work with us and through the United Way, some of the partners that we work with United Way that may have some of these grants that are available. So we don't have them, we don't issue them here, but we have experience with most of the ones that are available in the area. And again, we can help set you up with a housing counselor at one of the agencies that can help you to obtain the grants. And those can be used typically for down payment, for closing costs, things like that. So then we have the Homebuyer Dream Program, Ulster Savings Homebuyer Dream Program. This is something that we administer through an agency called Federal Home Loan Bank of New York. This is a great program. It allows for up to $10,000 grant that can be used for down payment and closing costs. There's a different set of guidelines that go along with that. There's some education course that you have to take. This program we're doing tonight doesn't quite qualify. The other one is a much more in-depth program. But it's a great program. It is limited time-wise. It actually was set to expire the end of August. They did expand it out, so now it goes through the end of November, which is fantastic. But we do have to move on that because the loan has to close by the end of November. So we can't apply for it, November 15th and expect to be able to close in time for the end of that month. So the clock is ticking on that. If it's something that you're interested in looking at, we want to make sure we're moving on that pretty quickly. If you're in a situation where you may not be buying for 3 months, 6 months, a year, what have you, that's fine. It's a program that has been around this was the 3rd year that it was there. And Federal Home Loan Bank in New York was able to get it refunded again for 2 more years. So we've had it for 3 years. We anticipate it being available again next year. So it doesn't mean if you're not getting in the next couple months, doesn't mean that we don't have it available to us. And then the last thing you see on here, the Housing Development Fund. Now this again is something I'm very, very proud of. So this is we work with a Housing Development Fund, is a nonprofit agency located in Connecticut. And they issue these only for people buying in New York and Connecticut. And what it is, we are one of only 5 banks in New York that are approved with their program to offer this. And in our area, there's really only us and one other bank who doesn't do a heck of a lot of, I know they don't do very many of these. So it's not an exclusive product to us, but it's pretty close. So what it does is it sets us up where we do a 80% first mortgage through a regular program, just regular conventional first, and then Housing Development Fund will provide a loan for 20% down payment. So this gives us some advantages. And I do want to stress that that is a loan, not a grant. And there's a difference. So there is a payment back. So there's a fixed rate. There's a fixed payment that you'll have for the life of the loan. It's done over a 20-year term, but it can allow us to open the door to some different programs and some different borrowers that would not be able to get into a home otherwise. Again, 80% first mortgage, 2% for this loan. 20% for this loan gets us up to that 100% financing. So again, it's a great way to open the door for people to get into a program and really be able to get into a home that they may not otherwise be able to do. Okay, so that's our general overview of capital and funds required for you to get into the home. What I'd like to do at this point is ask Jose, if you can go ahead and unmute yourself and let me know if we have any questions in the chat box, and let's go through those.
Well, good afternoon, David. Yes, we do have some great questions. One of them was, can they do a concession to actually do towards a loan, or is it just for closing cost?
Okay, great question. The seller's concession can only go towards closing costs and what we call prepaids, or the escrows that I talked about before, setting up for your taxes and insurance fund. So it cannot go towards, the seller cannot fund your down payment. If that's what they're going to do, then we would just lower the price of the house. So if the purchase price was $200,000 and they were going to give $5,000 towards down payment, it would have to actually come off the price and make the price $195. So it can only go towards closing costs and, again, what we call prepaids or setting up that escrow account. Okay.
Perfect. And then we got another one. Can you get a grant if you are not low income?
So most of the grants that I have seen have been catered towards the what we call low and moderate income. There are some grants out there that may not have income limitations on there. What I would do, again, is direct you towards the appropriate housing agency that's in the area that you're looking to buy, and they would have much better information on that than us. I know sometimes some unions may provide something like that. I think it's one of the teachers unions, I've seen something like that. I think one of the police unions, I've seen something like that. So there are some agencies out there where it's a narrow box. You have to be one of their members in order to get it. But yes, there are some that don't necessarily require income limitations.
Perfect. We do have another one. I think this question will cover most of the other questions that are coming through. But how much is low income?
Okay, so as I said before, so that will change depending on where you're looking to buy. It doesn't matter where you live now, it's where you're looking to buy. So it depends, the numbers, and it also, I'm sorry, it can also depend on the program. Some programs have different limitations than others. So to give an example, in Ulster County, for some programs, I think one of the numbers that's coming to mind, and I don't memorize these because they do change from time to time, and I would hate to ever give you an old number that's out of date. But I know for like one of the programs, I think $68,000 a year and change is one of the numbers. There's another one where it might be $80,000, something like that. So again, that's something that you're going to want to work with both your mortgage professional, your loan officer with, and also with, again, the housing agencies that help us to arrange for those types of, for if we're going for the grant or whatnot. There are some loan programs that also have those income limitations. And again, it depends on the loan program. What's for one is not necessarily going to be the same for another. So I don't want to, I don't want to give you false hope or discourage you just not knowing what your individual scenario is, if that makes sense.
Yeah, so most of the questions that are coming through are basically base-to-base scenario, right? So every scenario is different. So I think that's one of the things that we have to remember. And here, let's do this one, the last one. Has the process changed since COVID-19?
Okay, good question. We're gonna get to that later on. Okay, so that's something that we do cover towards the end of the presentation. So we'll put a pin in that one for now. Okay.
All right. And David, just one last one. Who's eligible for Home Buyer Dream Program?
Who's eligible for it? So again, it has to be a home. So Home Buyer Dream has to be a home that is being purchased in. Oh, we at Ulster Savings, we only deal in New York. We only lend in New York and we can lend anywhere in New York other than the 5 boroughs. We don't go into New York City. We can lend anywhere else in New York. So it has to be a house that's in New York. And then again, there are some income limitations depending on what county you're looking to buy in. So, and then again, so in that one, there's a time limit. That's the one where the home you have to close. We have to be all done and closed by the end of November. There's also a limit on the number of them that we have assigned to us. I know we still have a few that are left, but they're going quick. So if it is something that you're interested in and you have a house that's selected and you're pretty much ready to go, we still should be able to get in there if you can meet the income requirements. But again, I don't want to get into specifics because depending on what county you're looking in, that could change. And those differences, the reason why I don't want to go through it, the difference isn't necessarily $1,000 or so. There can be a big difference in those income limits, again, between like Greene County and Westchester County or where have you. You're going to see a big difference. So I don't want to get too deep on that. And yeah, I would, again, I ask you guys, make sure your questions are centered around the topics that we're going over at the time. And then also, if it's something that's real specific, don't want to get into it in this format, that's something just, you contact us. We'll have our contact information off at the end of this, and you'll reach out to us. I'm happy to go through those questions with you guys if it's more of a one-on-one situation. All right. So we're going to go ahead. Thank you, Jose. I appreciate that. And we're going to go ahead and move on to our next topic. And that is capacity. So again, your capacity, that is your ability to actually make payments on the loan that we're looking to take out. So, and when we say make payments on the loan, not just on the loan, but the whole house itself. So we're looking at what is your current income? Okay, what are the sources of your income? Do you have a regular job where you're getting a W-2? Is it a situation where you're self-employed? Do you have rental income? Do you have some kind of trust that you're getting income from? Unemployment, all types of sources out there. So we need to know what your current income sources are. We do also need to get into the history and the stability of that income. And again, I don't want to scare anybody off on something like this. If you have a history where you've had several job changes in the last couple of years, that's not a deal killer. Okay, it depends on what your situation is. If you have had multiple jobs because you've moved from one level to another level to another level, that's great. Obviously, we're showing progression. If you stayed at the same level, but things just didn't work out at one job or another, not a big deal. We're gonna look for some documentation. We're gonna get an explanation from you as to what happened and why we have job changes. Basically, what we're looking at for history, generally we look at a 2-year history. If you have a longer history than that at a job, at a particular job or in an industry, that can be what we call a compensating factor, where if your loan is borderline for being able to get approved, if we have some good job stability and job history, that might be enough, even though it's not a tangible number in terms of the dollar amount that you make, but a long period of time at one job shows some stability, and that may be enough to push us over the top. So those are things that can definitely help you, and in some cases can hinder you. So when we talk about history, though, be prepared when you talk to your loan officer. We're looking at 2 years of history on where you've been working and what you've been doing, or what your source of income are. Again, we can deal with if it's a pension, Social Security, any type of fixed income. None of that stuff is a deal killer. It's just all a matter of, again, what programs you qualify for and what type of documentation we need in order to move forward with it. So obviously, income is very important. We need to show that you have enough coming in to be able to afford not only the loan that you're getting, but also the taxes, the insurance, and all your other bills that are going on. Okay. Following up. So when we talk about capacity, when we talk about a house payment, what does that include? So principal and interest, which is your loan, okay? All of our loans are full principal and interest loans. And then you also have the taxes on the property, your homeowner's insurance, and then depending on what type of property it is, HOA, management, or maintenance fees. So your principal and interest, you set up, we have fixed loans, we have adjustable loans, whatever it is, we're going to start off, we're going to quote you on a number. Here's what you're, depending on your loan amount and your rate and how many years, that'll give us our principal and interest payment. To that, we're going to add in the taxes for the property. So property taxes in the areas that we service can vary greatly depending on, again, not only what county you're in, but even what town or city that you're in. There's certain areas, and even within certain areas of there, I use Poughkeepsie as an example. City of Poughkeepsie is wildly different than Spackenkill School District in terms of your taxes. Hyde Park is an unusually high tax area for where we live. There's just certain pockets that taxes can be higher or lower. So we're gonna look at that. And property taxes are public record. So in other words, for pretty much all the counties that we deal in, you can go out to the county website and pull up the existing property taxes that are due. So you can get a good idea for what we're going to be looking at. And there's no markup on those kinds of things. It's whatever the taxes are. Say, just use an easy number. If the taxes are $6,000 a year, we're just going to divide it by 12. That's $500 a month. That's going to be added into your payment. Okay, we don't mark it up or anything. By law, escrow accounts are very, very heavily regulated. We cannot mark them up. You cannot pay extra into your escrow account. If you make an extra, if you round off your payment, so your total house payment is $2,362 and you pay $2,500 a month, that extra funds is going to go straight towards principal. There's no other place that it can go towards. Okay, so that's when we talk about property taxes, very, very easy to find out how much they are on most properties. Your homeowner's insurance. So we say insurance on here. I always talk about homeowner's insurance. That's a general one that everybody has to maintain homeowner's insurance at all times. Homeowner's insurance is relatively reasonable, I would say, in terms of what you're protecting. Most of us have a car and we have auto insurance, and that can be insanely high. $10,000 car, the insurance could be $1,000, easily be $1,000 or $2,000 a year. That could be more than what your homeowner's insurance is. And in a lot of cases it is. So even though you're insuring something that's worth 10 times as much. So homeowner's insurance is something that you'll shop around for. We're not going to dictate to you who you get your homeowner's insurance from. Again, Ulster Savings has an insurance arm. We certainly would like you to get a quote from us, but not required. So you're going to get your homeowner's insurance quotes, call a couple companies, and whatever it is, we just take the yearly amount, we divide by 12, and that's how much is going to be factored into your payment. And in addition to that, if you're in a flood zone, you'll have to have flood insurance. There are plenty of areas around here that do require that. Typically, if you're very close to a stream or a lake or a pond, there's a good chance you're going to have some flood insurance that you may have to have there. And then you could also have mortgage insurance, and we'll get into that a little bit later in a little bit more detail. All that goes in. And then the bottom one, the HOA, that stands for Homeowners Association. So HOA dues, management, or maintenance fees. That's if you're buying a condominium, a townhouse, or what we call a PUD, planned urban development, a townhouse, and or a co-op. You're going to have and typically a monthly, sometimes it could be quarterly, but typically a monthly management fee. And that again becomes part of your house payment. You don't pay it to us, you do pay it directly to the management company, but we include it as part of your house payment to decide whether or not you can qualify for this home. Okay, because it's not just about the mortgage. Obviously, you could be in an area where the mortgage amount winds up being very low, but the taxes are so high, it pushes you over the level of not only what you can qualify for, but what you are actually comfortable with. Okay, because there's two different parts to this. Excuse me. So that's your house payment, includes all that. And then we talk about some terminology here. You'll hear about debt ratios, or DTI, which is debt to income. So your debt ratios, that's very important. What are we looking at? So there's two that we look at. One is the housing ratio, or front end ratio. That's the maximum percentage of your gross, Listen, your gross, not your net, your gross monthly income that can be used for a monthly house payment. So that's just the screen we just went over, the house payment, the mortgage house payment. Your house payment divided by your gross monthly income, that's your housing ratio. And then we have the back end ratio. So for that, same thing for your income. We take that housing payment and we add in basically everything that's on the credit report or anything else that you disclose to us. Okay. So, and that becomes your back end ratio. Now, most programs these days only use a back end ratio. There's still a few that'll use both, but most use the back end ratio. What we're going to do here at Ulster Savings, if you don't have a house selected and you're not close, you're just in the very, very beginning stages of being pre-qualified, we're going to start using a 43% back end ratio. So if you wanted to know what that means for yourself, if you're in a job and you made $60,000 last year, or you're on a salary that you make $60,000, I shouldn't just say last year, you're a salary and you make $60,000, divide that by 12, that's $5,000 a month. And you multiply that by 0.43 or 43%. And whatever that number winds up, that's what can be used towards your house payment, plus whatever's going to show up on your credit report, plus if you divulge anything else to us. And I should say that will include things like if you're paying child support or maintenance, that definitely gets added in there as well. But otherwise, it basically goes off of what you have on your credit report. So student loans, car loans, credit card, monthly credit card payments, things like that, that all gets added in, and that 43% is where we start with. Now, there are programs that we can only go to 43. There's programs that allow us to go to 45, and there's programs that allow us to go to 50. And there are possibly some programs where we can go higher than 50, although that's really stretching it. You're really getting a narrow box there in terms of what can go for that. There's very little of that anymore. So that's a way that you can on your own kind of take a look and see what that number is. Now, quite often that number that you calculate is higher than what you'd be comfortable paying. And so, well, that doesn't make any sense. Why wouldn't I be comfortable going to that maximum percentage? Okay, I know I'm talking a lot. I know I'm rattling on, but you can't mute me, guys. All right. So, sorry. So why wouldn't I be comfortable? Very simply, there's other things that you pay on a regular basis that we're not taking into account, okay? Pretty much everybody has a cell phone bill. We're not taking that into account. You have food, little things, food, clothing, heat, electric, your Netflix. Those of us that still are old school and have cable or satellite dish bills, things like that. There's plenty of payments, there's plenty of expenses that you incur on a daily or monthly basis that we're not taking into account. So we could absolutely work up a number for you and say, okay, great news. We came up with that your maximum payment that we think you could afford is whatever, $3,000 a month. And you might fall off your chair because that was twice as high as what you were thinking in terms of your payments. So, this is where we have to work together to make sure that you're not only qualifying on paper, but that you're comfortable in real life with what we come up with when we go ahead and move forward in terms of what that means as far as a maximum loan amount and a maximum purchase price, right? So there's what's on paper and then there's real life. And that's where you just have to work with your mortgage specialist on that stuff. Okay. Yeah, I think that's about what I wanted to go over there. I'm going to go ahead and ask Jose to go ahead and unmute yourself again, sir. And let's see, do we have any good questions in the chat room regarding our capacity?
Absolutely. So there are some great questions here. One of them is, what happens when you don't escrow the taxes? How much will you be paying at closing in taxes?
Okay, so some programs require that you escrow for the taxes and insurance. Some programs don't. If you decide to pay them on your own, then for qualifying, I know this isn't exactly what you asked, but I'm going to go over a couple things. For qualifying purposes, it doesn't change anything. We're still going to add those taxes and insurance in to make sure you qualify because it's still part of your house payment, whether you're paying it to us or you're paying it on your own as the bills come due, it's still considered part of your house payment. So it's still part of your qualifying. In terms of the cash that you need at closing, so yeah, if you're not escrowing, then we don't have to have, we just change it in our system that you're not escrowing, and you won't have to have that money available to close. However, part of what you need to pay at closing is the way that the taxes on almost all, I think pretty much all the areas that we work in, the taxes are paid in advance by the homeowner. So if the seller pays the taxes, let's say you're going to buy your house in December, and the seller just paid their school tax in October. Well, they paid a full year in October, but they only live there for October or November. And if you're buying the house in December, they don't want to pay those other 10 months for you to live there. So you're going to actually have to pay them back at the closing. Okay, so these types of numbers, there's almost no way for us to estimate it up front because we won't know until we get to closing. Our closing department will work with the county and with the seller's agent to make sure that we have the right numbers, and they'll do those calculations. So don't think that just because you're not going to escrow means there's nothing there for you to have to worry about, because again, you may not have to put anything in with us, but you are going to have to pay back the seller. And as far as the homeowner's insurance goes, generally you pay your first year fully in advance. Okay, so you're still going to have that. If your insurance is $1,000 for the year, you're still going to have to pay your insurance agent that $1,000 up front. You're just not going to have to put anything into your escrow account to start the escrow account with us. Okay, so you still have to be prepared for some expenses there.
All right, thanks, David. Another one is, what if you don't put the 20% down payment? What is PMI?
Okay, so I think we'll get into that a little bit more, but I can cover it here and then we can skip over it later. So PMI, so you'll hear a couple different terms for that. So there's PMI, MI, MIP. If you're doing an FHA loan, they call it MIP. It's a government program. Of course, they have to be a little bit different. It all basically means the same thing. So essentially what it is this: if you're putting down less than 20%, is this mortgage insurance is an insurance policy the bank makes you take out that protects us if you default on the loan. Okay, that's what it does. It is not mortgage insurance so that if you lose your job, your payments will be made. It's not mortgage insurance that if you're short 1 month, this will cover your payments. It doesn't do that. There are other types of insurance that can do that. We don't promote them here. We don't sell them here. We don't, quite frankly, don't really, I personally don't care for them. They're generally very, very expensive for what you get out of it. There's better alternatives for as far as I'm concerned, but they do exist out there. So your MI, PMI, MIP, basically it works as two ways. There's an upfront amount that you'll have to put in, and then there's a monthly amount that you would pay every month. On a conventional loan, for most loan types, you would pay it until you get down to 80% of the value. So if you're taking out 97% financing on a first mortgage, it's going to take you, if you never pay anything extra, it's going to take you a good 12, 15 years to get down to that point where the mortgage insurance is gone. On an FHA loan, if you're putting down less than 10% and you take out an FHA loan, you're going to have your mortgage insurance for the life of the loan. Okay, so you could be in the house 25 years and you're still going to have some mortgage insurance on there. And while that sounds really distasteful, understand that the insurance does adjust every year based off of how much you owe. So if you took out $200,000 in the initial when you bought the house, and now you're down to $50,000, your mortgage insurance payment is going to be very, very low, but it's still going to be there. So something that is something that we take into account when we look at what programs to put you in. It's just another factor. So yeah, so most programs, when you're putting down less than 20%, you're going to have MI. FHA, you're going to have MI regardless of how much your down payment is. And then there's a couple other programs like a VA loan or a USDA rural development loan. They don't have mortgage insurance, but they have something called a funding fee that really works the same way. So again, just all different terms that essentially mean the same thing. At the end of the day, it's a little bit extra of a payment for you that protects either us as the bank or the agency in the terms of the VA and the and USDA. Okay, let's see, you have one more good one there, Jose? Pick a good one out.
So I think that was it for now. They were also asking about the webinar. Is this going to be recorded? But I think we have details at the end for this, correct?
Yeah, we'll go over at the end. This is being recorded, but we'll go over how to access that at the end with our friends from United Way here. But all right, so let's go ahead and move on. Our third C, credit. Okay, so credit's very involved here. Okay, so what we're looking at, there's a lot of factors that come into your credit and how that affects you, not only whether you can get approved or not, but also how much ultimately this loan is going to cost you in either upfront cost or over the life of the loan. So we'll get into that a little bit here. All right, so credit scores. So credit score is a tough situation to go through because we as the bank have absolutely no control over this. Okay, and that's something I want to make sure everybody understands. Many times in my history of going through or working with people say, you know, the credit score you gave me was too low or whatever. We don't issue credit scores here. What we do is we pull your credit. There's 3 main credit bureaus out there. For a mortgage, we pull all 3 bureaus at one shot. It's called a tri-merge, tri-3 merged, all 3 get combined, tri-merged credit report. And you're going to have a credit score. In theory, you're going to get a credit score from each bureau. So what's going to happen with those credit scores, we're going to take out of the 3 scores, we're going to take the middle score, and that's what's considered your qualifying score that'll decide whether or not you can qualify for the loan. It also dictates, when I talk about the pricing of the loan, how much it's going to cost you. That can also affect your rate, or it can affect the fees up front, depending on how high or low your score is. A lot of people these days come into us saying, oh, I already know my credit score is X. Well, maybe, because if you went to another mortgage company and ran it, then yes, and their tri-merged credit report showed that your average score or your middle score was, you know, whatever. We should get basically the same score as long as it's within a very close proximity time-wise. But if you're getting your credit score, pretty much like almost every credit card nowadays, I think has an option where you can go on and get your credit score. You have things like Credit Karma, things like that, where you see the commercials on TV for some other agencies like that. Those are not government agencies. Those are for-profit agencies, just so you know. So when you're getting a credit score, that may be the credit score for the one bureau, but you have 3 bureaus that we have to worry about. And when you get that score from your credit card, we have no way to know at that time, is that your high score? Is that your middle score? Is that your low score? Or is that even a full representative score? What you'll see when you go into those, and I encourage you to go in and do it because it's free and it doesn't hurt you, because it doesn't count as a credit inquiry. And we hear about how, oh, if I check my credit, it'll make my score go down. You'll see a blurb when you go to do that through like your credit card, that it's not a full in-depth credit report that they're pulling. They're just getting a snapshot score for you. So it's a good indication of general indication of about where you are. What I like to use those for, what I recommend to my clients to do, is you can go on and check it. And then if you go in and check it, say a month or 2 months later, it's good to see what trend you're going. Okay, if your score on there is going higher, that's good. Then probably all of your scores are going higher. If it's going lower, obviously that's not so good. And all of your scores may be going lower. So it's good to see the trends, but I wouldn't get too wrapped up with the specific number. Somebody come in and say, oh, my credit score is a 750, which would be excellent. Except then we go and run the credit reports, and it turns out their high credit is a 750. Their middle is, say, a 680, and their low is a 620. And we see things like that. It's not, I wouldn't say it's common, but I've seen more than 100 points difference between your highest score and your lowest score. Well, how can that be? Because they're 3 independent companies and they calculate their scores differently. That's one of the things that makes my head ready to explode whenever I read an article about, here's how your credit score is determined, or anything that talks in very definitive terminology about how to figure out what your credit score is. You're not going to be able to figure it out on your own. You're just not. They have their own algorithms. They have their own computer programs that are set up to run it. And again, there's 3 different companies. If there was one way to calculate it, there wouldn't be 3 companies, there'd be 1 company, or if there was 3, your score would be exactly the same between all 3 because they'd have the same way to calculate, right? So just logic dictates that there are some differences in how they calculate. There's some generalities that we can talk about. Obviously, the better you are with paying your bills on time, the better your scores are going to be. The lower that your usage of your credit is, the higher your scores. And so what I mean by that is, say you have 5 credit cards and you have a credit limit between the 5 of $10,000. Well, if you owe $3,000 on that, then you're at 30% usage. That's great. If you have $7,000 charged up and you have 10,000, now you're at 70% usage. That's not so good, and that's gonna make your scores dip. Okay, so it's the uses of the account that's really going to matter. The number of active accounts matters, but it's not as important as some of the other things. So it can hurt you if you don't have enough credit, and a lot of people think that this is kind of backwards thinking, but it also, if well, my credit should be great, I don't use any. Okay, that's good that you don't have any debt, but it also hasn't shown us any history to know that you're really responsible enough to continue to make payments on a large purchase. If you have a car loan out there and you paid it perfectly and paid it off, that's great. If you have nothing out there, then we don't have anything to go to. So how do we know whether you're going to make your payments or not? And it's not just about money. We've plenty of people with plenty of money that for whatever reason don't pay their bills all the time or don't pay them on time all the time. Okay, and that's what becomes very important, is making sure that you are paying them on time. You see delinquency on there. If you have a couple of late payments, a 30-day late on a store credit card or 1 30-day late on a car loan from a year and a half ago, not a major deal, typically not a deal breaker, shouldn't crush your scores or anything like that. It's when we get into the serious delinquency that we really need to be concerned. And that's when we're talking about things like collections and charge-offs, or collections, charge-offs, bankruptcies, foreclosures, things like that. When it gets to serious delinquency, that's where it can really affect you on your qualifying, where sometimes your score might even qualify you, but the quality of the credit is such that we don't have a program available for you at that moment. Now, what we will do is we'll counsel you to say, here's the things that we think you should do to get into a position so that you can buy. And that's something I do want to stress here, is that this program that we're going through all this stuff today, this is not only for people if you're looking to put in an application tomorrow. If you are, great, but you might be 6 months away from wanting to do this, or a year away from wanting to do this. That's fine. You can't look into things like this too early. To me, the earlier you look into it, the better, so that you know what you need to do to get moving. Our guidelines do change quite often in this business, but some general basics of it just aren't going to change. We're always going to be looking for a better credit history than a worse credit history. We're always going to be looking for stable monthly income versus versus non-stable, that type of thing. So certain things are just always going to be true. So we want to know about delinquencies. We're going to find out when we pull the credit. So there's no reason to try to hide anything when you talk with your mortgage professional. It's going to be out there. We're going to see it. Let's go over it up front so we know where we stand. And then the last thing you see on here is alternative sources. So one of the things that I just talked about was if you have too little credit, that could be a hindrance, because how do we know if you can make your payments? Well, some programs allow us to go to alternative sources. And what does that mean? That means we go outside of the credit report. So if you are paying rent and you pay by check or by, I'm old school, so I still say check, but let's say you're paying by Venmo, or you're paying by PayPal, or just transferring funds electronically. As long as we have a record of it, it's all going to be about the documentation. If you're paying cash, like actual green cash, that might be an issue, because how do we really document that? We can't photocopy, $100 bills and say, okay, here's the proof of what I paid, right? So we're looking for something that we can document. So your housing history obviously is a major thing. If you're good at paying your rent, there's a good chance you're going to be good at paying your mortgage. So that can carry a lot of weight to it. But we can get into other sources too, and it doesn't have to be major accounts. You could have your car insurance. You pay that quarterly and you pay it on time every quarter, and we can show a year or two's worth of that. That could be a source. Things like electric bill, if you're paying your own utilities, again, old school cable or satellite dish. newer stuff like your Netflix or Amazon Prime account or something like that. So anything that we can show monthly or quarterly payments, so any type of regular payments that are being made, that could be used as alternative sources. And we do have some programs that allow those types of things to go so that we can kind of fill in the blanks versus what we actually see on the credit report. That's not going to change your score, but it could open the door to getting you approved for loans that otherwise you wouldn't be able to get into. Okay, so we do encourage you to use your credit, use it wisely, pay everything on time. And something else I always go over when it comes to those accounts. A lot of people think it's a good idea to close out their accounts. Oh, maybe I have too many accounts out there, so I better close there's these 2 credit cards I haven't used in 6 months, so I'll just close them out. Bad idea. And I've heard those given on, like, I look up YouTube videos and people giving advice and how to, get better credit and all that stuff. Again, makes my head ready to explode because it's terrible advice. If you have accounts, credit cards like that you're not using, but you don't have any type of annual fee, leave it open. No harm, no foul from your end, because you're not paying anything for it. So leave it open. But what do we see on the credit report is we see months going by without a missed payment. So that's great. We also see a history. We see a term. So say it's an account you've had for 5 years. Right now, we pull your credit and it's out there. Hey, you've got 5 years of perfect credit on this account. That's great. You close that account today and we pull your credit tomorrow, it's gone. It doesn't count for anything. Okay, once you close that account out, it doesn't count for anything, and there's no going back. You can't call Bank of America up and say, oh, I closed that credit card yesterday, I want to open it back up. They're not going to do it. They'll offer to open you up a new one. Of course, they're always happy to have somebody that pays their bills. They're always happy to have them as a client. But now you're talking about a new account. So now you just took out an account. Now your score might actually go down because you opened up a new account. Okay, so that's something that I believe very, very strongly in. I've had that conversation. I can't tell you how many times through the years. And unfortunately, most people tell me about it after the fact. And they say, hey, my uncle told me I should do this. That was good, right? And then I'm in position of going, sorry, no, not the best thing you could do. So, and then we move on. But so that is something. Now, if it's an account that does have any type of non-usage fees, so some kind of like annual fee or something like that, not a big fan of those. If your credit is decent to good, you should be able to find accounts, credit cards out there that don't have any type of annual fee. And I would encourage you to go for that. No reason for you to pay somebody for the pleasure of paying them again, if that makes any sense. So I like those. And there's nothing wrong with using those accounts. If you get your mileage or your cash back or points or whatever, put your groceries on there, put your gas on there, all that stuff, as long as you're able to pay it off at the end of the month and you don't think about it like out of sight, out of mind. Oh, I got all this extra cash lying around because I charge things. Obviously, you don't want to get into that situation. But otherwise, as long as you're disciplined about it and you're not getting in over your head, and you're the one that has to watch that stuff. So not an issue. Okay. So that's my basic rundown in terms of the credit that we're looking at. Again, there are lots of types of credit that don't come into play with what we're doing. Those things, if you're not using a credit card, if you're using a debit card, or you're paying cash for things that we don't take into account, the gas for your car, your utilities, your Netflix account, car insurance, things like that. Those are all things that you're paying, but we're not taking them into account unless we have to go that route with the alternative sources. Okay, so I think that's about what I want to cover in terms of credit. I'm going to go ahead and ask Jose if we have any good questions in there in regards to credit. Go ahead and hit me.
Dave, there are great questions coming up our way. So I want to start with this one. Does paying utilities help your credit?
So generally speaking, it doesn't have any impact on, when we say help your credit, it doesn't have any impact on your credit score. Those things don't typically show up on your credit report. I know that there's a movement going on. I've talked to some people where and I'm not sure who's doing this, but there are places that are recommending that you can call up the credit bureaus and ask them to add these accounts onto your credit bureau so that it shows up. That could be good for, again, when we talk about that last category with the alternative sources, that can help just make it a little bit easier for us to verify those payments being made. I am fairly certain that those do not impact your credit score. Okay, so is it good for you to do? Like I said, it can make it easier, but it doesn't, having a good payment history on those doesn't erase if there's any type of payment issues on your student loans, car loans, credit cards, the things that we do see on the credit report. You know, one good account doesn't erase a bad account. It doesn't work that way. Everything's kind of taken, we're going to look at everything individually there. So, you know, I have mixed feelings on that. I think a lot of people, when they're told to do that, I think they're being misled with the idea that that's going to really help to bump their scores up. And to the best of my knowledge, it does not. So, so I don't think it'll hurt you, but I don't know that it's necessarily going to help you.
Great. Thank you, David. Also, what if you have an overdraft on your checking account? Can that affect your credit?
Again, so a strict overdraft account typically won't show up on the credit report. There are some some places that do like a ready cash loan or an easy cash loan or something like that. It's not necessarily, it's sort of an overdraft account. So those may show up on the credit report, and they're going to show up kind of just the same as a small personal loan or a credit card. So again, could it help you? Yes, if your payment history is good and you're not overusing it. So in other words, you're not maxed out on it. Then if it does report, then it could help you. If it doesn't report, then it is something that could potentially be used as an alternative source if we need to go that route. And so I just want to make it clear, it's not real common that we get into that alternative sources bucket. So I don't want to give anybody the wrong idea that that's something that you all need to run out and make sure you got your 12 months of bank statements ready or cancel checks or whatever. We don't run into that real often. Doesn't mean that it's not going to apply to you in your individual case, but just again, I just want to throw that out there.
Great. Thank you, David. One more. Would you be able to recommend how many active credit accounts someone should have?
So again, I would shy away from giving a hard answer on this one. Not that I don't know it. It's just, again, I hate to give these answers, but that is the situation we're in. It depends. It depends on your circumstances, depends on what program you're going for, and it depends on kind of how you live your life and how you're able to manage that thing. What I can tell you is we have multiple programs that require at least 3 sources that have been active and used for at least 12 months. Okay, so I don't know that you can get into a situation where you have too many accounts. Okay, because again, it's not really about the number of accounts. From that point, it's not about how many accounts that you have and having too many. It's about how you're using them. So you could have only 2 accounts, but they're both maxed out. Obviously, that's going to be looked at much more negatively than having 10 accounts and you only use 2 of them, so you still have plenty of room on your credit limits available, right? So so that is definitely a depends, and it's more in the vein of not enough active accounts that can I don't want to say it can harm you. Because again, typically, if we just say we have 1 account showing up on credit report, maybe we have to get 2 alternative sources for you. So your rent payment and your car insurance, or your rent payment and your Netflix account, or whatever. So that's something that we can do where it can kind of be a combination of everything. But I wouldn't say necessarily that you can have too many. It's just if you don't have enough for that program, then we might have some extra homework to do. That's all. Not typically a deal killer. Okay.
Great. Yeah, I mean, these questions are, again, right, our base-to-base situation, because every loan is going to be different. But what about this one? So this one is, I have a doctor's bill that I'm paying. Is that going to help my credit?
Okay, so it depends. Okay, so We have a doctor's bill. Did it go to collection? Okay, so if it went to a collection and we see it on the credit report as a collection account, a lot of programs, medical collections by themselves don't hurt you. Okay, a lot of programs, as long as it, there's a spot on the credit report where we'll see it's medical collection. There's a lot of them. We don't require them to be paid off in order to close. We're not really concerned, even if it's a large amount, because it's medical in nature. Obviously, it wasn't planned. So we most programs do allow that type of leeway. So in terms of can it help you? Again, if you're making regular payments, if it hasn't gone to collection and you're making regular payments, that is something I would say we could use as an alternative source. Again, we're looking for regular payments paid over a period of time, typically a year. Some programs may require 18 months. Sometimes we may be looking for 2 years of history. So depending on what program you're looking at, that's something when you talk to your mortgage professional and you're going through and they're talking about, hey, I know I'll always ask, all right, at some point, Mrs. Jones, I'm going to have to run your credit. What am I going to see out there? And there's times where a person will say, I have absolutely nothing. And I'll press them on it because there's times where they have things and they, for whatever reason, they don't disclose it. A lot of it might be a credit card that you use, but you pay off in full at the end of the month. Well, that's somebody's playing around here. Okay, guys, stop trying to throw me off. All right, I can handle this. So sorry about that, folks. So yeah, they can lose my place. That's not nice. So yeah, the doctor's bill. So if it hasn't gone to collection, we could use it as an alternative source. If it has gone to collection, it may hurt your score, but it may not prevent us from moving forward as long as it says medical collection out there. But again, just be honest and open with your loan officer when you're getting set up, and you shouldn't run into any issues. Okay. So, all right. Thank you, Jose. Let's, we're going to go ahead and check how we're doing on time here. We are doing okay. So we're going to go ahead and move on to our fourth C. Collateral. What is the collateral? That's the property that you're looking to buy. Where is your home going to be? So a bunch of stuff that we're looking at there. The type of home, what condition it's in, and the fair market value. Okay. So let's start with the type of home. There's all different things you could be buying. It could be a regular single family house, freestanding house, could be a multi-family house. So anything that's 1 to 4 units, that's considered residential lending. So if it's 1 unit to 4 units, all in one building, or it could be multiple buildings on the same property, that's considered residential lending. We're happy to help with that. Anything over 4 units is considered a commercial property. Okay, this is and I want to clarify, this is not Ulster Savings Bank's guidelines. This is all mortgage lending guidelines going back to the beginning of time that I've been doing this. Every bank in the country is essentially going to run the same exact guidelines when it comes to that. So if you're looking at something that's 6 units, you want to live in one and rent out the other 5, not saying you can't do it. I'm just saying that's a whole different direction that we need to go. And we have a commercial lending department here at Ulster, and we would want to hook you up with somebody there to talk to you. It's a totally different approach on how to qualify somebody. So when we're talking about our programs, we're talking about 1 to 4 units. When it comes to the type of house that we're doing, the type of house in itself doesn't really matter. If it's a colonial or a Cape or a Victorian, not really going to factor in with anything that we're doing. That's just aesthetics of it. That's going to be up to you. The only thing that I would say that is the way that it comes into play is when we do an appraisal, and you see on the screen, we talk about fair market value. That's what we're talking about, doing an appraisal on the house. The appraiser is going to compare your style of house to other houses of the same style. It wouldn't be right to compare a single floor ranch house to a 2-story colonial. Right? They're really 2 entirely different things, and generally 2 different people that are going to be interested in those types of houses. So we're going to try to compare colonials to colonials and ranches to ranches and on like that. So the style of home doesn't really matter, but we could be looking at, so we got 1 to 4 units that we're talking about here. This again, where it comes into, could be a condominium, could be a townhouse, could be a co-op. We don't see too many co-ops in our area, but they do exist. There's a couple in Poughkeepsie that I know of. I think there might be one in Highland. That we don't see them too often. We do plenty of lending down in Westchester. Obviously, we're much more likely to see a co-op down there. I want to let everybody know we do not lend on co-ops. Okay, it's a completely different animal. And when you're buying a co-op, you're buying, it's basically its own little business. You're buying shares as opposed to actually buying real estate. Whole different animal, and we don't lend on them here. So most of the things that we're going over would still apply to what you're doing, but they definitely have their own guidelines and restrictions that that you have to deal with there. So could be, so again, we're looking at the type of home. We could also do manufactured housing. Okay, two different types of manufactured housing. You have what we call a modular home and then a mobile home. We do both. Modular home really is treated just like any other single family house. So typically no restrictions there. Manufactured homes that are mobile homes, there are some different restrictions there. We may not be able to go quite as high on the loan to value. We may not be able to do those 100% programs or 97%. You might have to have a little bit bigger down payment. There's some other restrictions in terms of the age of the mobile home and how it's constructed and where it's located, and you have to own the land that it's on and things like that. But we do quite a bit of lending on them here as well. So the type of home, pretty well wide open in terms of what we'll finance here at Ulster. The condition of the home. So doesn't have to be new, doesn't have to be in perfectly sparkling clean condition. It does have to be what we call move-in condition. Okay, so what we're looking at is, are there any health or safety issues that we have to deal with? And if there's any health or safety issues, that certainly could be a speed bump in us getting you closed on that loan. Sometimes those things, a lot of times those things may need to be taken care of before we close. And that may become a conversation and a negotiation between you and the seller of the house, because the seller, obviously, they're trying to sell a house. They don't want to put any more money into a house that they're selling, but you may not be able to buy it until that thing is said. And what are we talking about here? Usually it's pretty obvious stuff in terms of health and safety issues. So mold, that would be a big thing if we see black mold. And obviously mold usually comes from moisture. So then not only is there mold, but then we need to get to the source of that. And why is there mold growing there? Was there a leak that was just, a fresh coat of paint was slapped over and the mold then came through? So we're going to want to get into that and see what's going on there. Broken glass, any type of broken windows, anything like that. Missing handrails from stairs, from whether it be from a deck or interior stairs inside the house. If it's missing a handrail or the handrail is coming off of the wall, obviously that's a safety issue. We don't want to deal with that. So these are things that have to be addressed at the time as you're going through your negotiation. It's part of your negotiations, really. And if the seller's not willing to do them, it certainly could cause you some issues, because there might be a situation where, well, it's fine, I'll just pay for it. Well, you got to think about what that means. Do you want to pay for repairs on a house that you don't own? That's what you'd be doing at that point. Yes, you hope to own that home within, at some point, but you don't own it at that time. And what if you pay for the repairs to be done and the deal falls through and the seller decides to pull the house off the market or sell the house to somebody else? Now you're in a whole situation. How do you get your down payment back? How do you get your money back for what you put into the house? So that's what we call a buyer beware type of situation. I don't necessarily recommend that you get yourself into that. I would look to more put the pressure on the seller. So if there is health or safety issues, those are things that we have to look at and we have to be wary of. So how are we going to find this out? If you're not a contractor and you're not real handy, you don't have anybody, you're typically going to have an inspection done. That's something that there's a few programs that require it. Most programs it's optional, but to me, it should be mandatory. You should always want to get a home inspection done. The last thing you want to do is put all this money in and all this time in and get yourself all set up, move into the house, and 3 days later, your boiler blows. Or 3 days later, it rains and you realize now you have a leak coming through that you didn't know about. So you're going to want to get an inspection done. It's a couple $100 typically. You get a local inspector. They come in, they're going to spend a couple hours going through that house. And keep in mind what your purpose of the inspection is. You're looking for them to find problems. You are hiring them to find problems. Problems today, and problems a year from now or 3 years from now. And that's typically what they'll do is they come through and they put through a report. The report could be 15, 20 pages. The better ones, it's going to be very, very in depth. And you're looking for, okay, everything's fine now, but we estimate the roof only has 2 years of life left. Okay, now you need to decide, am I okay knowing that I may need to spend $12,000 in the next 2 to 3 years getting my roof fixed? And if the roof's estimated life is 2 years, I think that if we have a real bad winter, that could easily get closed way down to a shorter period. And you don't want to start having issues with that at any point. So that's something that we highly encourage everybody to go ahead and do, is get an inspection done. Now, the inspection is separate from the appraisal. The appraisal is required for most programs for us to do. And what we're going to do is we're going to order the appraisal. We order it through an independent third party. This is not a bank employee that goes out and does the appraisal. It's an independent third party. They go through and they're the ones that are going to come up with, you see that third bullet point there, the fair market value. So again, they're going to compare the house that you're looking to buy to other similar houses in the area. And similar meaning they're trying to get the same style. So again, colonial to colonial, ranch to a ranch, similar size, square footage. Again, doesn't make sense to compare a 1,000 square foot house to a 3,000 square foot house. Those are two entirely different animals. So we don't, they're not going to get into there. And then also location. So they're going to try to find 3 to 6 houses that are in the same general area. That doesn't mean the same street, but typically neighborhood or school district. Those are the types of things that they're looking at. Because again, the house is the same exact house that's in Greene County versus in Westchester is obviously going to have an entirely different market value, right? Or if there's some outside influences, you have a house that's across the street from a firehouse. That certainly is going to take a little bit of a hit on its value, because do you want to live in a house where you've got these sirens going off anytime over the night and have these the fire trucks rushing in and out? That comes into play as to the market value. So the appraiser is going to go through, they're going to do this report, and they're going to present it to us, and we're going to look, and hopefully the market value is going to match or exceed what the sales price is. If it doesn't, that's always a question we get asked in these things. What if the appraisal comes in low? Then that basically comes down to it being a negotiation between you and the seller. And the seller says, oh, no, I know this house is worth 300, but the appraisal came in at 250. And they say, well, it was a bad appraisal. Well, I don't know if it was a good or a bad appraiser. I don't appraise houses for a living. So we're going to look at it and we're going to see, what do we think? Do the houses they compared your house you're buying, do those make sense? Again, did the appraiser pick ones that are within the same general area, the same general size, age, things like that? So we're happy to look at it and give you an opinion. Hey, this does look like a good appraiser. Then we flip it back to the seller and to the realtors and say, okay, if you think the house is worth 300,000, find us houses that have sold recently for 300,000 that are similar to this house. And if they can't, well, then their argument doesn't really hold any weight, right? And realtors hate when I give this speech, but that's really what it boils down to. Your realtor should be, if you're using a realtor, they should be making sure the offer you're putting in is realistic in terms of what the value of the house is. From the seller side, I mean, hey, the listing realtor, they want to get as much as they can for the house, whether the market bears it or not. So it's really not their fault. But if they're going to make the argument that the value should be set at this place, they should be able to back it up with other houses that have sold. And it's possible. There are times where the appraiser maybe missed a house or two that sold that are in the area. So sometimes we can get that overwritten. But oftentimes it's just an inflated number. So then what happens? Well, now again, it's a negotiation with you and the seller. If the seller doesn't want to budge, then it's up to you. Are you willing to put in extra money to make the difference? So if the sales price is 300 and the appraisal comes in at 280, are you willing to buy the house for 300, knowing you're going to have to make, and are you in a position to make up that extra $20,000 out of your pocket? That's a decision for you and your situation. So that's not something we can tell you whether it makes sense or not, right? So what is something's value? Its value is what somebody is willing to pay for it. just like collectibles. You know, you hear of a baseball card selling for $500,000, and plenty of people will say that's crazy. And then there's another half of people that'll be like, oh, that seems like a good deal for that. Okay. It's all up to the individual. When it comes to houses, then it's going to be what would the average person want to pay for that, not what one individual would want to pay for it. And that's where we go and we say, okay, here's these 5, 6 other houses that have sold recently. They all sold for this price. Then that's what the going price should be. Okay. So all that being said, again, Jose, you want to go ahead and take a look? Do we have any collateral based questions?
Yes, David, we have a couple. Let me just go over them. One of them is, are we doing any mobile homes? And if we are, what type of programs do we have?
Okay, so yes, and I think I went over that quite a bit. So if you missed that, I'll just reiterate that there are programs for mobile homes that we do. You're typically looking at, you can do conventional financing, you can do FHA financing. There's all different types of programs out there that are eligible for it. They just may have some different restrictions on them. Again, it has to be built after, I'm going to say it's June 15th, 1976, I believe is the date. It has to be built after that. There was certain construction standards that were put into place at that time that anything built after that has to meet. Anything older than that didn't, and a lot of times they weren't very good quality. I don't know how many of those are still standing, because at this point you're talking about almost 50 years. So yeah, so there's some different restrictions on them. I can tell you in general, it has to be permanently affixed to a foundation. It has to have all of the running gear, meaning obviously the wheels, the axles, all that stuff has to be removed. And the house itself can't ever have been moved. This is very, very important. And there's no way for you to know that just looking at it. This is something, there's some documentation that comes with the mobile home. A mobile home to some degree gets registered like a car. There's a registration for it, just like a car. And that registration will tell you the year that it was built, and it will tell you where it was originally, the address it was originally placed. So it's built in a factory. It's shipped on the back of a flatbed truck, and sometimes in pieces if it's a double wide or triple wide or whatever, and it's placed. It can't ever have been moved from where it was placed. Okay, that's very, very important. There is not a program that I am aware of that you can do a home that has been moved more than just past its original place. So that's just something to make sure you check in with the seller on. And if it has been moved, there may be some specialty type of financing places that do that, but I don't know of any bank or mortgage company that'll finance that.
Great, thank you, Dave. This is a great one, actually. Is there a way to see what the value of the house is before the appraisal of other properties around the house that you want to purchase?
So you can ask your realtor to provide you with. So basically, one of the things the appraiser is going to do is he's going to go to the multiple listing service in the area, and that's where he or she is going to pull his what we call comps, comparable houses from. That's where they're going to pull them from. So the realtor can do that for you as well. That is not a public access. That's not something that anybody can just go on. You have to be a member of the like Ulster County Association of Realtors, Ulster County Association of Realtors, Dutchess County Association of Realtors, what have you. You have to be a member of that in order to have access to that. So your realtor can do it. If you're not using a realtor or you don't want to go that route, there are some websites like your Zillow, things like that you can look at, but I wouldn't necessarily take that as gospel. That can lead you down, really can be misleading, some of the figures that they have on there in terms of what a house is worth. So I know that there's really not a true replacement for an appraisal. So yeah, unfortunately, you're going to have to invest some time and some money in order to get that report.
And one last one. Due to COVID, do you think that the prices are being appraised higher for what they are?
So I wouldn't say specifically due to COVID, but COVID has during COVID, prices have gone up. Now, they were also going up prior to COVID. We've been in a recovering economy for a number of years now. And I don't want to get into a political discussion. I don't care if you're right wing, left wing, whatever. The economy has been recovering for multiple years now. So values have been going up. They have certainly gone up a little sharper in the last year and a half, especially in our more northern areas, your Dutchess, Orange, Ulster County, because a lot of people are moving up from the city, trying to get out of those areas where there's 500 people in a 400 square foot area, apartment building or whatnot. So that has caused values to go up. There's been a higher demand, so the value has gone up for those. And we are in what is generally referred to as a seller's market, because those values are pretty high and good and strong. So I like I said, I wouldn't necessarily, if COVID ended tomorrow, unfortunately, it doesn't appear to be the case, but if COVID ended tomorrow, it's not like I think the values are just going to stop growing or plummet at that point, because again, we've been in this recovering economy for quite some time.
Yeah.
Okay. So good questions. So definitely a good.
David,
good
I think this is a great one too, if you don't mind. So the last one was, can you access the county parcels to see the values? So the appraised value that the county gives you, is it the same?
Okay,
I'm sure
so
that's what it's going to.
yeah,
so that's a great question.
It's a very good question. So generally, so can you access it? Yes. Is it going to give you what you're looking for? No. So what it's going to give you is your assessed value, and then what the county is estimating your, some of the counties will also give you what they consider to be the market value or the true value, but those are not to be taken as gospel there. I'm sorry, it's just not. I can tell you, I was looking at one today in Ulster County. The listing price is $525. Thinking based on what I can tell online, I'm thinking the true value is probably going to be right around in the high fours, maybe up to 500. And the county had the what they consider to be the true value to be in the 200,000 range, and that it's again, it's probably half off. So again, not really a route that I can go. You can use the county website with parcel access. You can use that to find your property taxes, okay, that you want to sell. That's a public record, and I encourage everybody to look into that. Although make sure that you're getting the base amount. So if somebody's getting deductions for STAR or other type of deductions, you can get deductions for being disabled, or for being a veteran, or for being over, I think for being over 62. So there's all these deductions. Don't put any of those into it. Just take the raw dollar amount. But I would absolutely not count on that for the value. Those are just not up to speed generally. Okay. If there is one that is, I think it's more dumb luck than anything. That would definitely be the exception, not generally the rule. Okay. So good question. Unfortunately, not a good way to go. Okay. I think your better alternative, if you want to do some more homework before actually investing into the home and all that, have your realtor do the work for you. Or even call the listing realtor and ask the listing realtor, if you're not using a realtor yourself, ask the listing realtor to send you, can you send me comps for what you use to come up for the asking price? And they may say no, they don't have to do it. But in my opinion, they should be able to justify that price that they're asking. Okay. So that's more the way I would go. All right. So great job, guys. I appreciate those questions. Like I said, I enjoy these presentations much more when there's a lot of interaction with the crowd out there. I definitely feel like A, it makes me know that people are still there and paying attention, and B, it's a nice break from just me monologuing for an hour and a half, right? So I do appreciate that. So let's get into your getting pre-approved, getting pre-qualified by Ulster Savings, okay? So this is what we talk about. It is the first step to home ownership, is getting pre-qualified, right? It's what I say, you cannot do this too early in the process. You just can't. Oh, I'm not planning on buying in 8 months, so I'm not gonna do it now. Well, guess what? If you wait 6 months and you find the house and you fall in love with it and you say, this is it, this is the house I'm going to buy my first house and I'm going to live there for 15 years and I love it. and you haven't done any of the rest of this work and getting pre-qualified, you're setting yourself up for heartache. Okay, and we want to avoid that. We pull your credit and there's things on your credit report that you weren't aware of, or a program that you heard about doesn't exist anymore because it went away. Again, our guidelines change fast and furious in this business. So we want to make sure that you're getting pre-qualified early. I say early and often, because then as things change, you want to get it updated. You don't have to keep getting it updated every week, but you do want to check in with your mortgage professional, make sure that the programs that you're looking at still exist. Like we talked about that Homebuyer Dream program, you get pre-qualified, you think you're going to have it available to you, and now it takes you 6 months to buy it and it doesn't exist anymore. Okay, don't set yourself up for failure. Make sure you're keeping in good contact with your loan officer and make sure you're setting yourself up, get yourself pre-qualified first. Then you know what your house range is, what your price range and your loan amount range is that you can go look at. Okay, so it gives you your buying power. It's what we call our buying power. We're going to give you a letter or certificate that says you are pre-qualified. Now, Jose Lima says you are pre-qualified for up to a $275,000 purchase price of a conventional loan, blah, 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 blah. So you're going to walk into the realtor and show them this and say, okay, go show me houses in the 250 to 275 range. Because if Jose says that I can be qualified for it, then I know I can be pre-qualified for it and I'm not going to have a problem, right? It gives you that confidence to go in, gives the realtors the confidence that you've already done some homework and that you're serious and you're looking to buy it. They're going to take you more seriously. They're going to give you better service typically. Okay. You want to know what your down payment requirements are. And this is one of those things we say, okay, hey, based on the numbers, you can afford a loan amount of $300,000. But if you don't have any money whatsoever at this point, and we can't get you into one of those programs that's 100% financing, say, even if it's just 3% down, you have to put down. If you have nothing and you need 3%, well, there's a gap there. So maybe you can't, maybe you're not ready today. Maybe we have to save up the money for 6 months so that we can get there. Again, don't set yourself up for failure. Make sure that you're looking at what you get. You're talking in depth, honest and open with your loan officer so we can set you up with a plan that works. You also want to know what your payment is. We talked about earlier where we can qualify you for a certain level. That doesn't mean you're necessarily going to be comfortable with that size payment. So know what your new monthly payment is going to be. And again, as we discussed, your monthly payment is a lot more than just your mortgage payment, right? Mortgage payment, taxes, insurance, homeowners association dues, all that fun stuff has to be put in so that you know what your house payment is, okay? We do have a 100% online pre-qualification process. You can apply any time of the day or night. You want to go on at 2 in the morning because you can't sleep. You want to go on and enter an application online. If everything works from doing that, and what I mean is if you meet the guidelines on it, then you may be able to print out your pre-qualification letter right then and there. All right. There's other programs that they get real specific that you are going to need to speak to somebody before we can issue that letter, because the program needs more information than what we can put onto a simple application sometimes. So we're going to work on that with you. And I do want everybody to make sure they understand a pre-qualification is not a commitment to lend. There's a difference there. Pre-qualification up front, commitment is once you're fully approved by an underwriter, okay? So if you're talking to one of my team members like Jose about getting pre-qualified, as good as he is, he does not have the ability to actually approve the loan. That goes to a processor and then to an underwriter who can approve the loan. Things can change from the time that he speaks to you until it goes there. So there can be things that come up. There's things that are outside of our control. We talked about one of them already, which is the appraisal. Okay, we issue a pre-qualification, you put in an offer, the offer is accepted, we start moving forward, excuse me. And then when the loan goes to underwriting, the appraisal comes in and the house under appraises. Well, you can be approved, but not for that house because now there's a gap there in between. And now we have to decide. And if you don't have the money to make up the difference and the seller's not willing to budge, then we're not committing to lending you the money on that particular house. Or the appraisal comes in and there's health issues. Again, there's black mold in the basement or whatever. That again, that's something that's outside of our control. There's really no way for us to necessarily anticipate that type of thing if you're not forthcoming about it, or maybe you didn't see it when you walked through. Okay, so there's things like that. So the pre-qualification is the upfront portion. It's the first step. Very, very important. Get your buying power. But that doesn't mean that we're absolutely 100% be able to get you into that house that you want. There are some things that can happen along the way. So, but by being proactive with your pre-qualification, we can eliminate a lot of those speed bumps before they even happen, because we know what to deal with and we know how to move around them. Okay. Excuse me. So once we start moving forward, what type of documentation are we going to be looking for? Now, I have this list up here. You're happy, I'm happy to have you go through. I'm not going to read everything. You guys can read it on the screen. This is a general list. Okay, this is not a definitive list. And hey, you didn't tell me I was going to need this or that. It depends on what your situation is. Somebody that has other sources of income, we're going to need other sources of documentation. Please note the last item that's on that list. Other items needed will vary based on your circumstances. So once you talk to your mortgage specialist, your loan officer, and your processor, they'll go through with you and say, okay, here's what it looks like we're going to need. Then once we get that documentation, sometimes that leads to other documentation that we need to get. Okay, trust me, we don't want to make you give us more documentation. We don't want to have to look through additional documentation. So if we're asking for it, there's a reason for it. If we're asking for it, we need it. I ask you to work with us on that. The more that you work together hand in hand with us, the smoother the process is going to go, the happier you're going to be getting into your dream home there. Okay, so this is a general idea of some things that most programs are going to require. Other programs might require a little bit more or a little bit less, depending on what the program is and what your situation is. Okay. Okay. So again, this is just some terminology, some common types of mortgage loans. So a conventional fixed rate, that's the majority of the loans that we do. Just an everyday plain vanilla fixed rate mortgage, 30-year fixed, 20-year fixed, what have you, regular conventional loan. It meets conventional guidelines. Okay. Those are the things that most banks and mortgage companies, their guidelines are going to be the same, because we're all going through the same investors on that. And we'll talk about that, I think, a little bit more. Adjustable rate mortgages, or ARMs. Okay. You'll hear that terminology, ARMs. So a lot of people aren't comfortable doing them. That's perfectly fine. Other people only take them out. What does it do? Typically, it gives you a fixed rate for just a shorter period of time. So if we take out a 30-year fixed at 3%, you have a 3% rate for the whole 30 years of the loan, or until you pay that loan off. On an adjustable rate mortgage, there's going to be a period that it's fixed, and then it changes to an adjustable. So those periods are basically 3 years, 5 years, 7, 10. Those are your typical terms that are available. So the 30-year fixed might be at 3%, and say a 7-1, what we call a 7-year adjustable, 7-1. Maybe that's at 2.75%. I'm just throwing that out as an example. So for the first 7 years, it's set at 2.75. So you're going to save money over those 7 years, with the idea at the end of the 7th year, it changes to an adjustable rate. And that rate, again, as the rate adjusts, your payment adjusts. Is it going to be any worse? Don't know. I couldn't tell you where rates are going to be tomorrow, much less 7 years from now. Okay. And anybody that tries to, they're just lying. I don't care. They're just lying. Okay. Depending on what your scenario is, if you're planning on buying this house and selling it in 5 years, then maybe a 5 or a 7-year adjustable works for you, because you're able to save some money over that period of time. But if it's a house that you plan on holding on to for a long time, maybe it doesn't make sense. That is a risk level that's up to you. Again, we can't tell you whether or not it makes sense. Now, that being said, a lot of your first-time homebuyer programs, a lot of your low-income programs do not allow for those adjustable rates. Most of those programs, you're going to get a fixed rate. It's going to be pretty low. Right now, all rates are good. So it's going to be good. So you don't necessarily have that flexibility with a lot of those programs, because they don't want to get you in a situation where, now that the loan's adjusting, that payment can go up quite a bit at certain times. And now we don't want to set you up to fail where you can't make your house payment. Obviously, that's never a position we want anybody to be in. Okay. Construction and renovation mortgages, we do plenty of those here. You buy a parcel of land and you build a house on it, we can get you a loan to do that. you buy a house that is what we used to call a fixer-upper. Now, needs a little TLC. There's other little terms that you'll see in the listings online. We do a lot of those renovation mortgages. Again, it's a different animal. So some of the things that we've talked about, some of the types of programs aren't eligible for renovation programs, but we have several different programs here. We can do very low down payment programs and do it as a renovation mortgage. We have some of those low income programs that can be done as a renovation mortgage, but you have to understand what you're getting into with those. Those are not going to be closed in 30 days, 35 days. Okay. Those take some more work. You have to get estimates up front. You have to have contractors. In some cases, the contractor has to be approved to be able to do it. The contractor has to understand that they're not getting paid until the work is done. Those types of loans, as the work is done, the checks can get released. Okay, so that is, again, a different animal. I encourage you to talk. I don't want to get too deep into it here because even though I said we do a decent number of those, it's still a small percentage of the loans that we do. So that's something you talk to your mortgage professional about. Conforming mortgage, that is, again, that's just a dollar amount. It changes every year and it changes by the county. And so you see the next term there, the jumbo mortgage. So right now in, forgive me, in Dutchess County, I believe the dollar amount is somewhere around like $580,000, anything $580,000 of a loan amount or lower would be considered conforming. Anything over that is a jumbo. When you get into the jumbo mortgages, again, some of the things we talked about today don't apply because there's bigger restrictions. You definitely cannot be doing 100% financing or 97% financing. You have to have a bigger down payment. You may have to have a higher credit score eligible in order to qualify. There's different qualification factors for the jumbo mortgages, but again, we do lots of those. And then government insured loans. So that's things like your FHA loans, USDA or rural development, a VA loan. In New York, there's a program called Sony May State of New York, Sony State of New York, Sony May loans. Those are all programs that we offer here, and depending on your circumstances, may or may not be the right program for you. Okay, well, again, we do plenty of them. We like to do them, but sometimes it makes sense, sometimes it doesn't. Again, the one thing I'll say, anytime you get the government involved in something, it does not make your process any easier, and we'll leave it at that, okay? And then you see land mortgages there. So again, if you're buying a parcel of land that you plan on building at some point, but you're not quite ready to move forward with the construction loan, we can just give you a loan. We can just make a loan for you to buy the land. Again, those are a different animal. They require a higher down payment. They're a shorter term. So that's something to speak to your loan professional about if you're in that market where you think that you're going to buy. If you're going to buy the house and start building within a couple months, you're probably going to want to do that as a construction loan, so you can just take out one loan. You don't have to go through the process twice. You're going to buy a parcel of land and you're not going to build for 9 months or a year or longer, then you're probably looking at a land mortgage. Okay, and then when it's time to do the construction loan, we can do that as well. All right. So I know I went through that pretty quick, but Jose, if you want to go ahead and take a look and see if we have any questions up to this point.
No, absolutely. I do got to say, this group is very active with the questions. There are some great questions coming up. One of them being, if I get a 15 or 20-year loan, can I pay it ahead? And is there any prepayment penalties?
Okay, so at Ulster Savings, we do not have a loan. None of our loans, sorry, I just learned English today. None of our loans have prepayment penalties. Okay, doesn't matter what the term is, doesn't matter if it's an adjustable or a renovation loan or anything. None of our loans have a prepayment penalty. I cannot speak for any other bank. I will say that's pretty rare that there's anything like that. So regardless of your term, you should be able to pay extra towards principal, whether you do it in regular installments. So again, some people will just, if your payment is $1,375, they'll just round off the $1,400 and pay that every month. So you can do that. You can put a lump sum down once a year. The example I always used to give is you get your tax refund in March or April or whatever, and you get a couple $1,000. You want to dump that onto your principal. You can do that as a lump sum. That's fine. That's up to you. You can do it irregular through the year. Anytime you can pay extra, it's a good thing. As you pay the loan off quicker, your payment doesn't change, on a fixed rate loan, your payment doesn't change, but you pay the loan off quicker. If you pay the loan off quicker, you've now paid less interest. If you've paid less interest, you are in effect lowering your interest rate that you took out on that loan. So anytime we can pay less interest, that's a big win.
Great. What is the average down payment for a land loan?
So I believe that we are doing now, okay, I don't want to say average. This is something that is 100% up to the individual bank. So I'm only going to speak about Ulster Savings. There's a lot of banks that do not do land loans and construction loans. We had some massive changes to lending several years ago, and a lot of lenders got out of those markets, but we do them. I will say, I'm going to say we do 60% of the value. I believe at this point, I believe you have to have a 40% down payment. It might be 35, but I'm fairly certain it's 40%. I think we lend a max of 60% on land loans. So if it's a $100,000 loan, you're going to $100,000 parcel of land, you're going to need $40,000 as a down payment. That would be our requirement.
Yes, I mean, there are more questions coming up related to what you spoke about, David. So I think right towards the end of our seminar, you're gonna give an information, right, to where they can reach out about all these questions. Some of them are very similar, so you know, we definitely give that information at the end.
Okay, yeah, we'll do that at the end. Thank you, Jose. We'll do that at the end, and even once we're done, we will do some open forum question and answers for a little bit, although our time is running down here, so I think we just have a few more slides. Yeah. So let's go through. So one of the questions we did have earlier, how has COVID-19 affected the home buying experience? Well, it's affected every aspect of our lives, right? So why would the home buying experience be any different? And this is something that things have kind of come back and forth because we were on a good roll, right? And then the variants came out and things started getting a little ugly again. But in general, some new things came out, and some things that I think will stick around, and it's for the better. So when we talk about like open houses, so the old thing was an open house on a Sunday or Saturday, there might be an open house and the realtor just sits there all day long, realtor, and sometimes a mortgage professional might sit there all day long, and people come in and out as they please and they look around. A lot of those went away where they were doing isolated tours, where they were only showing the house to one person or one couple, one group at a time. And then we went with a lot of places went with virtual open houses, where basically they just took a movie. We all have our phones that can do that, so it doesn't even have to be that fancy. And they would just kind of go room to room, showing all the features that were in there. We saw a lot of that. We have 100% touchless application process that's available. Like I said, our people will meet with you, or if you want to do, again, you can go online and apply. You can call us and apply. As the process is going, we can do all of our paperwork, basically electronic signatures, via emailing documents back and forth, things like that. As far as the appraisal go, there's some situations where the appraiser may not have to enter the home, depending on the circumstances and the program that you're doing and where the house is and what kind of information we can gather. The appraiser, we may do an electronic valuation, an automated evaluation of the home, where the appraiser basically just goes and takes a couple pictures of the outside to make sure the house is still standing, essentially. That, again, depending on the circumstances. As far as the closings go, there's been a lot of changes there, where, you know, again, if you see anything in movies or you talk to your parents, your uncle, whatever, where the buyer was on one side of the table, the seller was on one side of the table, and the attorneys were moving paperwork back and forth, and you're all sitting there for a couple of hours as the paperwork is being done. A lot of that has gone away, where maybe the sellers don't even go to the closing anymore. They sign their paperwork ahead of time, and it's just you and your attorney and your closer sitting there going through and doing the paperwork. I know we here at Ulster, we set up an outside booth, essentially a tent, where when the weather's nice, we can just go and do it out there. So you got the fresh air. We're not as worried about the contamination. We did also set up a separate entrance. We set up a separate room with a separate entrance where you can come in and go. You're not going through our whole building and having to go through reception area and all that stuff. Basically, you can come into an alcove and immediately go right into the closing room. So you don't have to see anybody that isn't required to be at the closing. So there's all different things. Again, can't speak for other banks. We've taken some pretty heavy steps to make sure that everybody is as comfortable as possible. There have been some updates to employment and income requirements. Those are not necessarily in our favor in terms of making the process easier. So a lot of that has also gone away now. So there was some restrictions that were put on that have gone away. So generally speaking, paperwork is usually good for 4 months. So if you give us we run your credit today, we get a pay stub from you dated today. We don't need a new one for 4 months on that. They had cut that down to 2 months for a while because there was so many issues with businesses either closing or people that were full-time having to go part-time or something like that. So there were some changes. Those have pretty well gone away. So that's good. Hopefully they stay away. Again, we do have some, we do have some concerns about some restrictions getting put back on, but as of right now, we're still okay with that. Probably the biggest place that we were affected was with self-employed people because so many businesses had to change the way they do business and the amount of business that they could do or shut down completely in terms of where restaurants were and things like that. So our self-employed people, it doesn't mean that we can't do the loan. It just means there's some extra documentation that we have to get from you. We have to make sure. So in general terms, historically, self-employment income was just done by what your tax return said. Well, in the beginning of the year, that's fine because in March, if you did your tax returns, it's only been a couple months from the end of the year. Now we're getting into the time of year. If I get your 2020 tax returns, that's showing me numbers from over 9 months ago. Now, so that's not really a good indication of where you are today. So there's some extra steps that we take, some extra documentation that we need. So if you are self-employed or have rental income, that type of thing, again, open and honest with your loan officer. Make sure you're talking to them about it up front and what extra requirements we're going to have at that point. I will say, for the most part, your credit and your down payment requirements haven't changed. We still have our 100% programs, our 97% programs, all that stuff. Credit scores are still, certain programs have limits on how low a credit score can be. Those types of things really didn't change. So we are still pumping those away, pumping those out, as same as ever. All right. So that's a good overview of what's been going on with COVID. Just to go run through real quickly, some other terminology that you may hear out there. Again, you see them on the screen. LTV, loan to value. So again, that's how much you're borrowing in comparison to the value of the house. If the price is 100,000 and you're borrowing 90,000, you're at 90% LTV. Simple, right? Debt to income, we went over that. That's how much debt you have compared to your income. That's that percentage that we went through, the back ratio and the front ratio, or we'll go to 43 or 45%. APR, your annual percentage rate. Basically, this is different from your interest rate. And what it does is it's typically a little bit higher than your rate. So when you're quoting with your loan officer, you're going to get an interest rate, say 3% or whatever it is, and your APR might be a little higher. Why? Because the APR is something the government came up with a long, long time ago, way before I started in this business, to help you try to compare two different lenders. Two lenders could have the same rate, but the APR could be different. And if one's APR is higher than the other, what that means is generally their fees are a little bit higher. So the APR is a reflection of the fees, the closing costs that the bank is charging you. So I wouldn't use it, again, as a hard and fast rule because there's a lot of ambiguity in the law. Go figure, the laws aren't very clear. So some banks may include some fees that other banks may not include when they calculate out their APR, but it's a good thing. It's a good thing for you to know. Points, we hear the term points. We don't hear it too much anymore, but again, the last generation, that was a big term that was thrown out there a lot. Don't pay points or always pay points. So points are prepaid interest. So basically a point isn't good or bad. It just is. It depends on your situation. So the points, if there's 1 point on a loan, that's 1% of the loan amount. So if we have a $200,000 loan and you're paying 1 point, that's $2,000. Very simple. Why do you pay points? It's a relation with the rate. So depending on your circumstances, what type of program you're doing, what your LTV, loan to value is, what your credit score is, you may have some points that are automatically assigned to you. It's called risk-based pricing. I don't want to get too into that, but basically kind of the riskier the loan is, the higher the fees and the points may be, but you may be able to get rid of some of the fees by raising your rate up. So in other words, it might be 3% with 1 point, and you could pay 2 points and get 2.75. Or maybe you go to 3.25% with 0 points. points. Okay, so there's a relationship between the points of the prepaid interest and the rate. Again, not good or bad, it's all situational. Okay, PMI, we went through that, the mortgage insurance, not going to go that. So the other two terms I want to throw out here, Fannie Mae, Freddie Mac, you see those on the screen. We hear those in the news. Fannie Mae is a little bit bigger. These are the two biggest agencies basically that provide the guidelines that we go by when we're making a mortgage. This is what the overwhelming majority of banks and mortgage companies in America, they're going to go by Fannie Mae and Freddie Mac guidelines. And that does, like I said, it kind of drives most of the loans that we do. Those are government-sponsored agencies, GSEs, government-sponsored agencies. They're not technically government agencies, but they sort of are. It's a weird thing. It doesn't matter for your day-to-day life. But basically, like I said, they set the guidelines. And when we're looking whether or not we can approve you, we're looking, does it meet the guidelines for the program? Okay. We here at Ulster, we also do what we call portfolio loans, meaning where if you have something that just doesn't quite fit into their guidelines, but we think you're a good prospect, we still may make that loan and we'll do it as a portfolio loan on our own guidelines. So just keep that in mind. If you've been turned down someplace else, we may be able to do it. I'm not saying we approve everybody, but there are things that we can do that other places just can't or won't. Okay. And then here's just the general steps to buying a home. All right. So first thing you want to do some homework, do some legwork on your own, gather some information ready so that when you do speak with your Ulster Savings Bank mortgage specialist, you're ready to go and you have those answers. We talked about a whole bunch of stuff over the last hour and a half, so you want to go by that. Once you're done, you get your pre-qualification certificate, you go and find your realtor that you're comfortable working with, and you go out and you look for houses. You find your dream home. Great. Now we get down to the nitty-gritty of really completing the application, collecting all that documentation, signing disclosures. Then you work with your process. Your loan will be handed off to one of our processors. Again, all of our people are employees here. We don't have any contractors, subcontractors. Our underwriters, our processors, everybody's an employee here. So again, I used to be easy to say we're all here in Kingston, but again, we do have people working remotely, but you would never know. You still call their extension. It goes right to their phone at their house. Everything works great, right? So you work with your processor as they ask for documentation or clarification, work with them. Again, we don't want a thick file, right? We're not looking to approve you by the pound. We're looking to get you through as quickly and as effortlessly as possible. So if there is something we're asking for, again, there's a reason why we're asking for it. Please work with us so we can get to that dream home a little quicker. Once you're clear to close, set a closing date. You get there, warm your fingers up because you're going to sign a whole bunch of papers. Sign your name and date over and over and over again, take the keys and start the next chapter on your life. Okay, again, 3 big moments in your life, typically the 3 biggest moments: getting married, having kids, buying a house. So we're happy to be part of that process, part of the big 3, and we want to help you get there with as little muss or fuss as possible. All right. And that, ladies and gentlemen, boys and girls, that is our presentation for you. So really appreciate, again, I want to thank all of my friends, my partners at Dutchess and Orange United Way for working with us and giving us this opportunity. I want to thank Jose, Michael for coming on here and helping us out, reading the questions and doing the introduction for us here. I'm going to go ahead. We are a little overtime here. If my friends here at United Way are okay, we'll open up for a couple of questions. And as you can hear, I'm starting to lose my voice, so it's not going to be too much longer. But you see on the screen here, so we do advertise that we're eligible for a $750 certificate that shows you're completed the course and it's good off of closing costs. So all you have to do is complete the 112 question test that we're going to email out to you. And as long as, no, we're not going to do that. All you have to do is email the code together, right? We work with you together. We work with agencies like United Way together to help get you into the home. So we're going to email the code together to Dreams Happen. That's dreamshappen@ulstersavings.com. Email the code together to us and give us a couple of days, please. Every time I do one of these things, I will get an email at 7 o'clock the next morning. Where's my certificate? Okay. This is a manual process. Give us a couple days to get them out to you. I promise you, we're going to get them out to you. If you haven't heard from us the end of the week, then by all means, next Monday, go ahead and reach out to us. Again, same email address, dreamshappen@ulstersavings.com, and we'll make sure that it gets out to you. But go ahead and email us. Let us know what you thought of the presentation. I look for your feedback from you. If you have any additional questions, feel free to ask them through there, and we'll look to hook you up with one of our mortgage professionals who can help answer all your specific questions. You see the phone number on the screen there at the 338-6322. Please reach out to us. Let us know what you think, and we're happy to help you. Michael, I don't know, did you have anything that you wanted to go over in terms of United Way?
Well, did you want to take any more questions live, or just have them put them in the chat and you will?
I think
answer
at
them
this
later?
point, honestly, I'm going to save my voice a little bit.
It's probably smart. You're gonna need it again. No, I think that was fantastic. There was so much information packed into that hour and a half plus that there's a lot for people to digest, and I'm sure they're going to follow up with questions directly to you guys. I think fully understood that it'll take a couple of days to get all the questions answered for everyone. I just want to say thank you to everyone for attending and for sticking with us the whole way. I'm really excited for everyone's journey and buying a home and working with Ulster Savings, and from everyone here at the United Way. Thank you so much for this great evening. Thank you, Dave.
All right, thanks,
Appreciate
guys.
it.
Really appreciate you attending. Have a great rest of your evening, and we'll see you when you're ready.
Thank you.
Get that dream home.
Thank you.
Thank you so
Great job,
much.
Michael.
Thank
Have a
you, everybody.
wonderful
Have a good
night.
night.
Go Birds.
Thank you.
All right. Great job. Great job, Michael. That was awesome.
Thank you. Yeah.
Thank you so much. It was incredible. Thanks, Katie and Tier, Emily, Jeannie, everyone from Ulster. I'm going to go ahead and end it. Have a great night,
That's good.
everyone.
Have a good night, everyone.
Right, thanks, everybody.
Thanks,
We'll
Dave.
see
That
you
was
soon.
so
great.
much.
Yeah.
It was
Totally
wonderful.
appreciate it. Have a great night.
Goodbye.
Bye.